Fixed rate versus ARM mortgage. Which one is better? If you're buying a home in 2026, one of the biggest decisions you'll make is choosing between a fixed rate mortgage and an adjustable rate mortgage, or ARM. I'm Jahanbin with Maxim Lending, and in this video I'm going to explain the difference when an ARM can make sense and, most importantly, what you need to watch out for before choosing one. Let's start with a fixed rate mortgage. With a 30-year fixed mortgage, your interest rate stays the same for the entire life of the loan. For example, if you get a 30-year fixed mortgage at 6.25%, the rate doesn't change 5, 10, or 20 years from now. Your principal and interest payment remains predictable. That's one of the biggest advantages of a fixed-rate loan. Now let's talk about an ARM. An ARM usually starts with a fixed rate period. You might see something like a 5-1 ARM, 5-6 ARM, 7-6 ARM, or 10-6 ARM. The first number generally tells you how many years the initial rate is fixed. For example, a 5-1 ARM typically has a fixed interest rate for the first 5 years. After that, the rate can adjust periodically based on the terms of the loan. A 5-6 ARM also typically starts with 5 years fixed, but after that the rate can adjust every 6 months, and this is where you need to pay attention. Watch out for the caps. Don't just look at the starting interest rate, you need to understand the interest rate caps. There are generally 3 important caps you want to understand. Initial adjustment cap, how much can the rate increase at the first adjustment? Periodic adjustment cap, how much can the rate increase at each subsequent adjustment? And lifetime cap, what is the maximum interest rate allowed over the life of the loan? These numbers can be much more important than the initial ARM rate. Here's an example. Let's say you have a $600,000 mortgage. A fixed rate mortgage is 6.50%. Your ARM starts at 5.75%. That sounds attractive. But you need to ask yourself, what happens when that ARM starts adjusting? If rates are lower when the adjustment occurs, your rate could potentially decrease, depending on the loan's terms. But if rates are higher, your payment could increase. That's why you should never choose an ARM based only on the initial rate. When can an ARM make sense? An ARM can potentially make sense for someone who doesn't expect to keep the same mortgage for a very long time. For example, maybe you're buying a property and expect to move in 4 or 5 years. Or perhaps you believe you'll refinance before the first adjustment. But here's the important part. Never assume you will be able to refinance. Your future refinance depends on your credit, income, property value, equity, market conditions, and future interest rates. So you should make sure you can afford the loan even if the ARM adjusts higher. When does a fixed rate make more sense? A fixed rate mortgage may make more sense if you want long-term stability and don't want to worry about future rate adjustments. If you're buying your long-term home and plan to keep the mortgage for 10, 20, or 30 years, knowing exactly what your rate is can provide valuable financial predictability. Here's what I want you to watch. When you're comparing a fixed mortgage to an ARM, don't just compare the advertised interest rates. Ask your lender, what's the initial rate? How long is the initial fixed period? What is the index? What is the margin? What are the initial, periodic, and lifetime caps? When can the first adjustment happen? How frequently can the rate adjust after that? And most importantly, what could my payment become if the rate reaches the maximum allowed rate? That's the number you really want to understand. My final advice, don't automatically choose the lowest rate. And don't automatically choose a fixed rate either. The right mortgage depends on how long you plan to own the property, how long you expect to keep the mortgage, your financial situation, your risk tolerance, and the specific terms of the loan. An ARM can offer a lower starting rate, but you are taking on future interest rate risk. A fixed-rate mortgage gives you more payment certainty, but you may pay a higher rate up front. So before you choose, compare the total cost and the potential future payment, not just today's interest rate. I'm Jahanbin with Maxim Lending. If you're buying or refinancing and want me to compare a 30-year fixed against an ARM based on your specific scenario, reach out to me. And don't forget to like, subscribe, and follow Home Loan Secrets with Jahanbin for more mortgage and real estate education. I'll see you in the next video.